So, what happens when you find what seems like the perfect company? A leader in its field, incredible growth, everything's clicking. Is it an automatic buy? Well, that's exactly the question we're tackling today by taking a deep dive into one company that, on the surface, seems to have it all: Rainbow Children's Medicare.
Right? What even is a perfect investment? Is it just about huge growth, amazing products, fantastic leadership? It's a tricky question, but today we're going to figure out how to answer that, all by looking at this one really remarkable company. And it all starts with a number that just jumps off the page: 33.8%. So what is that? Well, that's the average profit growth Rainbow Children's Medicare has posted every single year for the last 5 years. I mean, think about that. Any company that can grow its profits by a third year after year is clearly doing something very, very right. So who exactly are they?
Okay, so Rainbow is India's biggest hospital chain that is totally focused on pediatric and obstetric care. We're talking about healthcare for kids and for mothers. They have found this really specific and super important niche for themselves in one of the fastest growing healthcare markets in the entire world.
So first, let's build what we call the bull case. Basically, the argument for why this company looks like an absolute monster of an investment. And it all starts with what makes them so tough to compete with.
See, Rainbow's success isn't just one thing. It's this powerful mix of smart decisions. They've got this laser-like focus on women and children, and it's led by a founder who's actually a pediatric specialist himself, not just some suit. They expand smartly by leasing buildings. That's the asset-light model. And they offer everything under one roof, which keeps patients coming back. All of this together gives them a real premium brand in the market. And you can see that strategy paying off right here in the numbers. This number, 25.1%, that's their average revenue growth every year for the last decade. That is not a short-term sprint, my friends. That is a long-term marathon of incredible, consistent performance. But look, growth by itself isn't the whole story. You've got to have profitability. And this is where Rainbow just blows the competition away. Their operating margin, which is just how much profit they squeeze from their main business, is almost 33%. They're not just getting bigger, they are fundamentally better at turning a dollar of sales into actual profit. And it really all comes down to this. You look at key metrics like return on equity, return on capital, fancy terms for how good is a company at using money to make more money, and they are rated excellent. The bull case is just overwhelming. I mean, financially, strategically, Rainbow looks just about perfect. Which, of course, brings us to the big, flashing question. A company with this kind of growth, this kind of profitability, this kind of strategic advantage, it almost seems too good to be true. So, what's the catch? And this is where the story pivots. Welcome to the bear case. This is where we find out why even a perfect company might not be a perfect investment. And the problem isn't the business itself, it's the price tag. And that all comes down to this really crucial idea: valuation. Think of it like buying a house. You find the most gorgeous, well-built house on the block. It's perfect. But what if it costs 50% more than every other house? Is it still a good buy? That's the whole dilemma with valuation. It's not about how great the company is. It's about what you have to pay for that greatness. And here is the problem, right here in black and white. Investors are paying nearly 58 times Rainbow's annual profits for a single share. That's way more than the average for similar companies, which is around 42. And the price-to-sales ratio? It's an even bigger gap. The market isn't just pricing in perfection, it's charging a huge premium for it. The analyst's own scoring system makes this crystal clear. Check it out. Financial health? A stellar 8.5. Growth prospects? A fantastic 8.2. But then you get to valuation, and it's just 5.8. It is the one obvious weak spot in an otherwise flawless report card, and it really drags the whole investment case down. And that high price, it makes other smaller risks feel a whole lot bigger. The company is mostly just in South India. There's a risk they might stumble as they try to expand. And, of course, there's what we call key person risk, since they depend so much on their founder. When you pay a premium price, you have zero room for anything to go wrong. Okay, so we've got our two competing stories. On one hand, the bull case, a financially incredible market-leading company. On the other, the bear case, a stock that's priced for a future so perfect, it leaves absolutely no margin for error. So how does an analyst actually weigh all this to make a decision? Well, they use a tool called a discounted cash flow analysis.
It sounds complicated, but it's really just a way to guess all of a company's future profits and then calculate what that pile of cash is worth in today's money. This gives them a base case or most likely value, along with best case and worst case scenarios. And here it is, the big reveal. While the market is pricing the stock at 1,469 rupees, the analyst's math says its most likely fair value is actually 1,250 rupees. That is a pretty significant gap between the price you pay and the value you get. The stock, according to this analysis, is overvalued.
All right, so we've seen the bull case, we've seen the bear case, we've seen the math. It has all been leading up to this exact moment, the final verdict from the analyst.
And a final recommendation is hold. Now, it's not a sell because this is a fantastic company, and you probably don't want to bet against it. But it's not a buy either. It simply means if you already own it, it's worth keeping. But if you're looking to get in, right now is not the time. The price is just too high. And this one sentence from the report really captures the whole story perfectly. A high-quality business, but current valuations limit upside potential. Yes, it's a great business, no question. But the current price, the valuation, is so steep that it basically eats up most of the potential future reward. And this really brings us to the core lesson of this entire analysis. And it's a simple two-step process for smart investing. Step 1, find a great company. Step 2, buy it at a fair price. Rainbow passed step 1 with flying colors, but for now, it fails on step 2.
But the report doesn't just leave us hanging. It gives us a very specific, actionable takeaway. The analyst suggests that a much better time to start buying would be if the price drops below 1,200 rupees a share. That's the point where the risk and rewards start to look a lot more balanced.
So, I'll leave you with a final question to think about for your own portfolio. We all get excited when we find a truly great company, but the real test is having the discipline to wait for the right price. So let me ask you, when does a company you absolutely love become too expensive to buy?